Good afternoon, everyone. Thank you for joining this webinar. We will be talking about thematic passive funds. So we have started this whole new series of webinar in which on first working day of every month we review both the domestic market and international market. It's called alpha beta. Then we in the mid of the month around 15th we talk about ETFs, which you can invest in at a given point in time. So, depending on the current market scenario, we pick out three, four ETFs, which you can sort of pick out for lump sum investment. That webinar is going to happen probably next week. And then we are also sorts of going to talk about segments of ETFs or product segments in few of the webinars. So for example, this week we are going to talk about themes. Very soon we're going to talk about smart beta again, and then also about international products like FANG, etc. So today I'm going to talk about thematic products, and we have plethora of them, and hopefully using them I'll be covering the market also. Idea is just to give you sorts of ballpark on where you can invest in themes right now, whether that should be tactical or long term in nature, and what sort of expectations you can have while investing in any particular theme from a risk return point of view. So before I go ahead and talk about themes, like I do always, a very quick recap of what has happened in the market, and and the change in momentum which we had seen in market uh, post first round of tariff announcement by Mr. Trump, which was around 7th of April, I guess. Post that, when he then paused the tariff implementation and market suddenly started recovering. That sort of recovery, I think has played out well. I think we have long forgotten the deep corrections which took place in December, Jan, Feb, March of last year and this year. So market right now is looking mostly green. So Nifty is on a 3 month basis, and this is 6th June ending data, on 3 month basis is up by 11%. Next 50, which is the next 50 large cap stocks after Nifty 50, is up by almost 13%, more than 13%. In fact, if you're looking at mid cap, it's up by 18.5%, right? It fell also much more than large cap. And then small cap, which was down more than 20%, is now down 19.3%. So much so that from its 52-week high, small cap is only down now 6.3%, right? And mid cap from its all-time high is only down 2.7%. So market has seen a very very sharp recovery in last 3 months. And if we talk about very quickly about sectors, because we are going to talk about themes, one of the major sorts of support which sorts of helped Nifty recover so much is a very good performance of financial services, right? As financial services is up by almost 16%. We have seen a very sorts of reasonable rally in PSU Bank also, which was sorts of a laggard in previous months, but in last 1 month itself it is up by 15%. So PSU segment, bank segment as a whole, is now up by 21%. Financial services up by 16%. So that has been very important. And now if we compare, the PSU bank is back again beating private bank on a 3 monthly basis, and that has been very important because as we all know, IT has not done well, and on a 3 month basis that is only sector which is negative right now, 1.4%. It's in negative territory. Apart from that, all the major sectors have given pretty reasonable returns, several of them in double digit returns. So apart from financial services, if you look at energy, it's up by 13%. Oil and gas, again, sub segment of energy is up by 13.7%. Very importantly, capital goods is up by 21%. A lot of that is driven by this huge rally which is happening in the defense sector, and India manufacturing is up by 13.2%. On the consumption side, I think, like we had predicted in a manner, it is playing a bit differently. So consumption is up 11.5%, but FMCG is only up 8.3%. So we just highlight that FMCG still is relatively underperforming even the broader consumption segment. Media is up by 16.7%. Reality, again, in last 1 month is up by 21%. In last 3 months is up by 26% almost. Infrastructure is also up 14%, and Alpha 30, which is basically a smart beta index, is has recovered almost 18.2% in last 3 months. So that particular product fell significantly. It was down almost 27% in from its all-time high when market correction took place, but has recovered also quite quickly. So it is up by 18.2% in last 3 months. And low vol, which is a different, completely opposite strategy to alpha. Here, the investment happens in less volatile stocks, has moved up by 9.2%. So that has been that's a quick recap of the market. On the international side, again, the entire uh, uh, conversation about US China trade talks, healthy earnings on US corporates, and the fact that market now believes that Trump is not going to sorts of follow up and levy significant tariffs. These threat of tariffs was more to bring people on the negotiation table, right? And people believe that there are a lot of deals which are going to be made, and that has sorts of, in a way, calmed the market down, and market has in a way continued to recover. So now Fang is up by almost 12% in last 1 month, continuing almost a breathtaking rally which we are seeing in Fang stocks. Even Nasdaq is up by 10%. S&P 500 is up by almost 7.2%. Top 50 is up by 8.6. Even in China, now we are seeing some sort of uh, uh, rally, because there is a belief that trade deals are going to be done. From a valuation point of view, very quickly, Nifty 50 is now trading at 13% premium post this very quick recovery in the market. Mid cap is roughly up by 13% or so. And across the market, if you're trying to look at any particular segment from a valuation point of view, I think it's only financial services and very to an extent auto, which is just trading at a 3% discount. So financial services and auto, which is trading at bit of a discount from a valuation point of view versus 10-year average. Apart from that, I think we are back to conversations which we are having in September last year, where we are talking about whether now the valuations are justified, uh, based on what we are seeing. Earnings this year was very low single digit, and the next year or so earnings are also not very sorts of encouraging. From commodity point of view, again, I think in the last call itself we talk about how bullish we are on silver much more than gold, and that's what now we are seeing. Silver in last 1 month has given 10% return, 9% in last 3 months. We are looking at silver at now at 52-week high around $36. from an MCX, it's almost 1.05 lakhs. So we are seeing sorts of a good run up in silver, and I think that will continue to happen if the positive talks between US and China continue. Silver is a lot dependent on how China is doing, because a lot of its consumption are in industries which have sorts of huge base in China. Gold is around 3,300 levels. I think it will continue to consolidate around 3,200 to 3,400 levels. I don't see again a huge correction or a significant correction in gold. I think it will consolidate here, and then further up move will depend a lot on how central bank buying pan out in the near term, right? Whether China is continuing to buy gold, whether Chinese uh, uh, government companies are going to continue buying gold, etc. Now, dollar is right now at around 98.86 from a dollar index point of view, and we have mentioned multiple times that seems like the Trump government is comfortable with dollar around these levels. Brent is right now around at 66.5. So yeah, so that's a very quick recap on what is happening in domestic market and on what is happening on international market. Now, these are all the products which we have on the passive side. We right now manage 51 products, including fund of funds. But on theme, we have several interesting offerings which we will cover. So we launched India's first manufacturing fund on the passive side. That has done really well. So we'll talk about that probably in the second part of the presentation. Then we launched India's first EV and new age automotive ETF. It invests across the supply chain, value chain of electric and new age automotive segments. Then we have India's first and only product which focuses on discretionary consumption, right? I was talking about the FMCG is not doing well, but we believe that in the long run, when per capita income is increasing, when wallet share of discretionary items are increasing, discretionary segment will probably do better than FMCG segment within the consumption space. So this is the only product, either on the active side or passive side, which focuses on discretionary consumption. Then we were talking about select IPO product with market doing well. We are going to see again plethora of IPOs probably in the second half of this year, and this product is a very rule based portfolio approach to invest in IPOs. And because RBI cut rates last Friday, I think we have to talk about financial services ETF. So that is one more product which I'll be talking about. So there are a couple of products which I'll be covering, and in the end I'll be talking also that from an investment point of view, how you can approach these different offerings. So very quickly, I think nothing tells story better than returns and how these products have performed over the years. The first one is obviously financial services. Last 3 months have been really good, like I mentioned 5 minutes back. PSU segment has done better. Last month has been very supportive for PSU Bank, and I think financial services now with with the rate cuts happening will sorts of again probably be a good place to invest in. So here we only have ETF. If you look at from a performance point of view, last 3 years it has given around 18% return. So compared to a lot of other segments, this has been a laggard, if I can say that, from a returns point of view. If you're looking at a 3 year data, then we have EV and new age automotive, which in last 3 years given around 24.5% return. This is the index return, because ETF we launched sort of fag end of last year itself. And in 3 months it has recovered almost 14.2%, but still on a 6 month basis it's negative 4.5%, right? Auto has not recovered so much as a lot of other segments. Manufacturing is one product which we have more than 3 year history. This has given 23.6% return. Again, we'll talk about the product. Very good return compared to Nifty and Nifty 500. 5 year return is also stupendous, and I think that with focus on Make in India, which is continuing, right? Especially on the defense side. I think this segment continues to be one segment which will do well. Then we have new age consumption, which in last 3 year has given again 24.6% return, and 5 year 29.7. It focuses on discretionary items, so it has, again, like I mentioned, autos, consumer services, fintechs, AMCs, etc. And then we have select IPO, which is a sort of a portfolio approach to invest in IPOs and new listings. Again, I'll talk about this product. Done really well in last 3 months, almost 21% return in last 3 months. If you're looking again at a 2 year period, 30% return, 3 year period, around 20.6% return. So a lot of these segments have done well compared to a broader market index like Nifty 500, or our blue chip index like Nifty 50. Now, these are the performances of our ETFs since they were launched. I think index performance encapsulates it better. But again, all these ETFs are present, and the TERM are mentioned on the right most side. Now, first I'll talk about a new age consumption. Like I mentioned that this is the only product, either on the active side or on the passive side, in the entire mutual fund industry, which focuses on discretionary consumption. When you are earning that extra 10,000 rupees, that where are you spending that extra 10,000 rupees, right? You may spend on tours and travel. You may spend on e-commerce website. You may spend on fintech. You may spend on stockbroking or AMCs for investment purposes, right? You may spend on buying, if you got more money, probably buying a two-wheeler or a four-wheeler. That is what is discretionary spending, right? And that is increasing in India, right? And just to if you have to imagine the scale, just look around, right? People are getting more and more aspirational. Nobody is going and buying additional FMCG product if he has more money. He is going to buy a better phone, a better two-wheeler, a better car, uh, uh, go out to travel, or probably invest in stock market, or probably invest in a mutual fund, etc. So that is what this particular product will focus on. So as Indian per capita income rises, the spending pattern of people also changed, right? And that is what we are focusing. The wallet share of spending both in rural areas and urban areas are shifting increasingly towards non-discretionary items, and this is one product which will sorts of focus on that. So very quickly moving to the breakup of the product, it consists of as you can see on the bottom right hand side, autos around 24-25%, consumer services, which consist of your uh, uh, fintechs, e-commerce, etc., around 24.7%. Your consumer durables, which are white goods, etc., around 15.7%. Reality around 10%. Telecom around 7%. Your services and media around 5-6% or so, and textile around 1.9%. So the entire focus is on discretionary spending, and if you look, it consists of 75 stocks. No stock will have more than 5% weightage, and the sector cap of 25% applies. And very importantly, if you look how well this product has done in last 2, 3, 5 years, that will tell you the story, because this shift in spending patterns sorts of has started to happen around COVID and post COVID. People behavior has changed, and you can see that that's why in last 3, 5 years the performance of this particular product has also gone up, and we believe that going forward for next 5, 7, 10 year, like when we launched India manufacturing product around 3 years back, we were pretty confident on manufacturing segment scaling up in India, and we continue to be confident on that. And the product has sorts of, from a return point of view, justified that. We believe that this discretionary segment in India will also sorts of continue to rise and boom. So this is one product. Both, so we have both ETF as well as fund of fund, which you can sorts of explore to invest in this particular segment. The second product is, which I'm going to talk about, is Select IPO. Right. The idea was, uh, and this is again only product on the passive side which invest in new listings. Right. There is, I think, one or two product on the active side, but on the passive side, this is the only product. So what we do is, the idea is to capture IPOs and spin-offs which are happening in top 500 space. So this product will invest in large, mid, and small cap IPOs and spin-offs, right? By that, we'll be sorts of avoiding the froth which we may see in SME segment or micro cap segment. And the idea is that most of the companies which are getting listed are new age companies, are companies in segments which are, let's say, not well captured in Indian capital market. And idea is to, through this product, will not only provide a portfolio based exposure to these new listings, but will also provide a very unique sectoral exposure also. And once we do this sorts of take this exposure at a portfolio level, you also avoid risk associated with a single IPO, right? And we know that IPO market in India has increased. How, like in 2024 itself, there were around 94 IPOs, which was significantly higher of past 2 3 years, and amount raised has been also significant, because you are seeing IPOs in large, mid, small cap, SMEs, micro cap, etc. And that's what that's and that will continue to happen, right? We'll see more and more companies getting listed and also spun off, right? And there are a lot of companies right now which are talking about spinning off their new age businesses into a different entity. And this is one very interesting slide, right, which talks about the risk of choosing one IPO, right? For example, if I just simply look at all the IPOs since 2006, almost 596 IPOs companies have listed on main board, you'll see return skewness, right? There are 172 IPOs which gave a listing day return in the range of minus 25 to 0%, and more than 15 stocks which gave a return of minus 25% or more on the negative side. So there are almost 185 stocks which gave negative returns on listing day. Because let's be honest, right, most of us invest in IPOs also for listing day gains, right? Obviously, majority invest for a more longer term, but there are people who invest for listing day performance. But this data shows that there are a good number of companies which are giving negative return, almost one third companies. Then you have only 200 companies which are giving return between 0 to 25%, and the actual segment which you are targeting, which are giving more than 25% return, are actually less than one third. So it's very difficult to identify companies which sorts of will give you listing their return. And if you, even if you look from a long term point of view also, it's sort of difficult to play out that uh, what should be the ideal holding period for a particular IP, because it depends on multiple things. First, at what valuation company was listed, what are the earnings growth and earnings prospect of that particular company, how well that segment sector is doing, etc., and how well that company will do in coming 1 2 3 years or so. And that is why it becomes very difficult to sorts of chart out at what point in time this particular investment will turn profitable and when should I exit. And that becomes more true for new age segments, right? For example, Zomato. Look at Zomato. It started giving return fairly late, right? Almost, I think, into the almost fag end of third year or fourth year of the listing. So as the other companies, right? So what this product will do, this BSC Select IPO, that it will include all top 500 IPOs and spun-off entities after 3 months of listing. So this portfolio will be assessed on a quarterly basis, and we look at every new IPOs and every new spin-offs, whichever has completed 3 months post listing. Why we are taking 3 months? Because first, passive products are not allowed to invest pre-IPO, and second, because we believe that 3 months is a good time in which we can avoid initial market volatility, and hopefully we'll get one quarterly return, because while we have said 3 months, typically index mein aate aate there'll be 4 5 months of listing would have passed. So we'll also seen one quarterly return, and market would have sorts of hopefully become for that particular stock less volatile, and hopefully we hope again some sort of price discovery would have happened. And then post that 3 month of listing, if it is still in top 500, that particular company will be included in the portfolio. And just to avoid any stock concentration, the top stock will be capped at 5%. That's why I see Geo at 5%, around 5%, PB Fintech at 5%, Macro Tech Developers, Zomato, Max Healthcare, 197, Nika, Mankind, SBI Cards, Mazgao Doc, etc. Will be capped. So this is, I think, a very uh, structured and rule based manner to take exposure in the IPO and spin off entities. If you're looking for listing day gains, this is not the product for you. If you're looking for sorts of pre IPO investment, this is not the product for you. This is product if you want to invest in new listing from a longer point of view, right, after it gets listed, and the stock will remain in the portfolio for 5 years, this new listings, and after 5 year it will be removed from the portfolio. So we will in, we will have these stocks spin-off entities for a period of 5 years or so. And if you look at performance also, 2 year, 3 year, 5 year, IPOs have done really well. And if you believe that this good market which you are seeing in India will continue apart from few hiccups, I think this is a good product for someone who are looking for IPO investments, right? It is a high risk, high reward product, right? Now, let's move to manufacturing. And what I'll do, I'll just not talk about PLI, because PLI conversation has been done quite a lot in last 4 5 years. So let's focus on what the intent of this particular portfolio is. It will consist of large cap, mid cap, and 50 small cap companies as a universe. So top 300 companies are considered, and from that top 300 universe, companies which are forming part of manufacturing segment are included. So capital goods, including defense, auto, healthcare, uh, metal, consumer durable, chemicals, etc. Wherever manufacturing is taking place, those sort of segments are considered. What we have also done is that industrial manufacturing, which defense is also part of, industrial manufacturing and automobile will have minimum 20% allocation, so that it remains true to the label. So roughly, as you look right now, auto ancillary has around 27% weight, capital goods, which includes defense, is around 20% weight, healthcare is around 15% rate. Healthcare, basically pharmaceutical companies, it won't have exposure to hospitals, etc. Metals is around 12% weight, chemicals around 7.7%, your refineries, etc., around 8.5% weight, and consumer durables around 4.5% weight. Remains true to the label product. Again, top stock is capped at 5%, and it has done really well since we have launched also. And its recent history also, since government started focusing significantly on the manufacturing segment. For example, look at last 5 year performance, around 30% return last 3 year, 23.6% return, last 2 year, 28.6% return. So it's a very good diversified product to take exposure in manufacturing theme, including defense. Large cap exposure is roughly around 68%, 28% towards mid cap, and around 3% towards small cap segment. So again, one product which has done really well, and we believe that will continue to sorts of uh, do well. Now, very quickly, I'll talk about electric vehicles. Again, one product which we have is EV and new age automotive. Here, the idea is to provide exposure to the entire EV value chain, right? Not just automobile manufacturers, but also companies which are participating in PLI or are building a capacity for battery production, companies which are producing or will produce chemicals to be used in batteries, auto ancillaries which are providing components for EVs and other new age automotives, and even IT companies which are creating these ADAS systems which are used in all these EVs, as well as now in basic cars also, to provide some level of automation. EVs, we already know, is gaining significant market share globally, but in India it has just started, right? We still have a very low participation of EVs, just around 5% or so in across the industry, around 4-5% in four wheeler segment. So we expect EVs to become a significant sorts of player in the automobile segment. Government is also significantly focusing on it, and I think, like I mentioned, that this product will focus on upstream, midstream, and downstream. From the chemical producers to the battery manufacturers to the electric vehicle component providers, to the IT guys who are creating ADAS technology, etc., and the automobile manufacturers also. So this product is something which captures the entire value chain. Again, what we have done is we have created this product in a very unique manner, right? So it will, as of now, it consists of 33 companies from Nifty 500. It has 8% cap on OEMs and 4% cap on non-OEMs. So your Mahindra, Bajaj Auto, Maruti Suzuki, etc., can have up to 8% weight, but something like a Reliance Industry, which is not a pure play player, or other non-pure play players, will only have a 4% weightage maximum. And aggregate weight of OEMs are capped at 40%, because if you look at EV and other new age automotives, non-OEMs are also significant contributor to the value chain. So this is on the right hand side, the entire top 15 companies. On the bottom side, you'll see how this particular product has performed in last 2, 3, 5 years or so. And again, a very unique sorts of portfolio and approach to take exposure in the EV and new age automotive segments. Lastly, I'll be talking about financial services, and this is the only ETF. So what I talked about earlier, we have ETF as well as fund of fund, but for financial services we only have the ETF, and I think there is a banking ETF as well, but this is this is the only financial services ETF in the market right now, which gives you exposure to top 20 players in financial services segment. So it has, from a weightage point of view, around 70% exposure towards private bank, around 10% towards NBFC, around 7% towards public sector banks, life insurance around 4%, then other segments around 2% and lower. And again, if you want to take exposure in financial services, uh, in an ETF, in an index, then I think this is probably much better than the banking ETF as of now. So in last 1 year has given around 23% return. A lot of that return has happened in last 3 months itself, like we saw in the first slide of this presentation. Now what I'll do is I'll just uh, again go back and talk about where probably you can look from an investment point of view, right? Because we have talked about almost 5 products. It was a bit much to take, but I think if you ask me, Siddharth, which is one product which you will suggest right now, I'll probably pick out India New Age consumption, which can be uh, a long-term allocation. I we believe Me and the AMC believe that discretionary segment is a segment which is going to get bigger and bigger in India, with rise in per capita income, with the wallet share of discretionary items increasing both in rural and urban areas, and with hopefully tax cut implications getting visible by this year, and a new pay commission coming next year. Hopefully we'll see consumption reviving in India, and that is where I believe that India new age consumption for next 5 years is a very good sorts of play right now. So if you ask me, pick out one particular product out of this for 5 year point of view, I'll probably pick out new age consumption. If you're looking from a short term point of view, I think financial services is one thing which I'll I'll pick out, but then that's an ETF only. Again, the other ones are pretty sorts of use based. If you don't have an exposure to autos, then EV and new age automotive is something which you can look at. Select IPO is something which is doing really well, but it's a high risk, high reward product. So if you're looking for investment in IPOs or IPO segment, I think this product is good, but you should have a bit of a lower allocation, because it will have its ups and downs. So you'll see this product being more volatile, in fact, compared to other products as well. So right now, if I have to pick out one product, it will be the new age consumption from a 5 year point of view. If you're looking from a short term, I think you look at financial services ETF for investments. If you're looking at select IPO, I think you'll have to obviously look at its volatility also. It's a good product, a unique way to invest in IPOs, but it will not suit everyone from a risk profiling point of view. So that's it. I'll be happy to take questions. If there are any questions, please post them, and I'll be taking them one by one. So let me quickly just go go to the end slide also. Yeah. I think there's one question by Nitin Kumar. You think we can suggest small cap to our clients? I think yes. We think that small cap as a segment, especially after correction, was fairly decent from an investment point of view. If you look our previous videos, we have been talking about investment in small cap segment when it was down more than 20% or so. I think even now small cap makes sense, but do staggered investments from rather than doing the lump sum. So Ramesh, we don't have any ETF for gold miner stocks in India. It's I think there's one question by Sekar Sangeetam. I hope I'm pronouncing your a name correctly. Yes, I think it's a very good question. He is saying that anchor investors exist after 6 months. There would be volatility. Is it not prudent to invest after 6 months, where you also get one quarterly performance? I think that's a good fair point, Sekar. What we have done is that typically, so index get reviewed on a quarterly basis, right? And and at least 3 months of listing should have been passed. So let's say 3 साढ़े 3 महीने की listing हो गई, then review is done, and then the stock gets included, which again takes 1 month or so. So typically we are including index any stock around 5 months or so. uh, I think fair point. You can probably wait out if any major IPO is coming and for it to get included in the index, and then probably 1 more month for the initial volatility to go down. But what we had done is that we typically thought that market will, in initial 1 2 month, the initial volatility will die down, and hopefully when one quarter comes, market will further uh, price the IPO at a more reasonable level. So that is how we have gone by. But probably yes, like I mentioned that there will be volatility when anchor investors exit around 6 months or so. So one more question by Sekar. I have not shown the volatility. That's a very good point. Uh, Again, you can probably visit our website and see that volatility, but I have tried to cover it somewhat. But again, for the sake of everyone, thematic products are more volatile than market cap based product. Of all the products which I've talked about, select IPO will be the most volatile product. I think I mentioned that also in my presentation. Probably then most volatile will be EV and new age automotive. Then will be uh, manufacturing, then financial services, and then financial services and probably new age consumption will be somewhat on similar levels. So there was conversation on, can you show me the screen where all ETF and fund of fund offered by Mira was mentioned? So yeah, I am projecting that slide itself. Uh, Yeah, so there's one good question on what is the best SIP thematic fund or index fund for my 5 year son. Uh, so right now, if you ask me in general, I'll probably say you can look at within equities multi cap ETF we have, or multi cap as a segment for investment. I think we like that pretty much from a long term point of view. And from a theme point of view, if you're looking for a theme, then like I mentioned that new age consumption is something which I'll pick as of now. There's one question on subscription to international funds. Sankar, we are also waiting for any news from SEBI. As soon as uh, we are allowed to open international funds, we'll jump to that opportunity. But till now, we haven't heard anything from SEBI regarding uh, revision of uh, limits of investment in international market. So as of now, the ETFs and fund of funds remains closed. Silver target price. So sorts of I won't be able to give a target price, but what I believe is that if China, US China trade deals happen like what most of the market now believes, I think silver is going to be on a reasonable good run. So if you ask me between gold and silver, probably I'll be more bullish on silver. There's one question on Hang Seng ETF, good option to invest. Uh, it's a good option to invest, but premiums are very high. So our ETF, Hang Seng Tech ETF, is trading at a 20% premium. So I will never suggest to invest there because the premiums are so high. But but China market right now looks good for investment. So if you have any other opportunity where you can get a fair price, you can look for investment in that particular product. But do understand the risk associated with investment in China. It continues to be highly volatile. Yeah, I think there's a this is one question which I'll have to take with China restriction on rare earth. Do we foresee higher risk for EV and new automotive fund? Uh, that's a good question, but see, the impact will be there on our auto companies. But let's see. I think it's pretty. um and very soon to comment on it, right? Let's let it play out because a lot of things which are happening geopolitically, we are seeing a lot of reversals also taking place. So probably I'll wait it out and see whether those sort of restrictions continue in the long run or not, or it is just again one of the power plays which larger economies are doing to get a better deal. But yeah, I think probably I'll take this question and see how about. There's one question on why we have highlighted some of the products. So yeah, on the thematic side, smart beta side, and national side, the ones which we have highlighted, we are the only ones who have this product, and that's why we have highlighted some of the products. So apart from, I don't know why debt offering was highlighted, but apart from that, whatever we have highlighted in orange, we are the only ones who have, or we were the first one to launch those products. Is ETF better option for returns than fund of fund? Is there any past data? Anish, so it's a very good question because since I was talking about ETF and fund of fund, nobody asked that. So if you are investing through a zero brokerage account, right, and you are buying and selling after looking at the INAV, which is you're buying and selling अब being aware that ये सही भाव है इसी के भाव के आसपास मुझे लेना है then ETF returns will be better than fund of fund. So if you are sorts of very an investor who looks at ETF price, INAV, and then buy and sell, the brokerage impact is not significant, uh, uh, and you're holding it for the long term, then ETF will have a better return than fund of fund. There's one question: can we invest at S&P 500 top 50 at current level? Uh, NSO again, our ETFs are trading at a premium. I think maybe top 50 is not at a 20% premium, but please check out the premium at which these are trading. Probably I'll look for at these current level. I won't be too enthusiastic to invest in S&P 500 top 50. I'll probably wait out a bit, see how next 1 2 month from entire this tariff war plays out, and then decide whether I should invest or not. Lump sum is probably strict no in S&P 500 top 50 from a current level point of view. Yeah, so yeah, I think there's a very good question on Shraddha. Shraddha is asking how ESG rating is assigned to securities in an ESG fund. That's a great question, Shraddha. So typically, any index provider takes a rating from a third party. So when NSE launched the ESG index, it used to take ESG rating from Sustainalytics. Would have loved to go and talk about how Sustainalytics do the ESG rating, but now they have shifted, and now uh, on Friday itself, we got a notice that NSE themselves have set up a subsidiary to do ESG rating. So as and when they come out with more on ESG rating, I'll hold a session on by NSE itself, because very soon they are going to move towards shifting these indices on ESG ratings done by their own subsidiary company. But anyways, what they have done is very quickly, there are uh, good amount of parameters which are mentioned for environmental, social, and governance parameter. For example, for Sustainalytics, it is more than 100. Now, then it is based on a particular sector, whichever parameters are more applicable is sorts of identified, weightages are given to those parameters, and then each companies are assessed based on those parameters, and then the weighted average scoring is done to arrive at ESG score. I think I'll take probably one or two more questions. Yeah, so in terms of how do we provide liquidity in our ETFs, we typically uh, have a market maker. In our case, we have Mira Asset Capital Markets, who does market making in all our ETFs. Apart from gold and debt, where other there are other market makers, and they provide in our domestic ETFs uh, both buy and sell uh, at a very small spread. So they provide, like, if tomorrow there's a demand of 5 crores, they'll provide 5 crores of unit. If there's day after tomorrow there's a demand of 50 crores, they'll provide 50 crores rupees of Nifty 50 units. So I'll just take one last question. So Gauri, it's a very difficult question to say whether multi-cap active fund will beat multi-cap ETF. I think the best way to go about is to invest some portion in ETF and some portion in active funds, because active funds have their own cycle, right? Because of different fund management style. Uh, like we've seen the large cap, we have seen the mid cap also. So I believe same thing will happen in the multi cap in the long run. So invest some amount in active funds, which you like, and some amount in ETF, just from a diversification point of view. Um, so I don't have global EV automotive ETF right now in terms of performance point of view, but point taken. If you can probably send me your email ID or message, I'll probably share the latest update on EV and automotive ETF. So yeah. Last question, because it's an important one. So there's one question which is asking liquidity of Mira ETF compared to others. So we have, like I mentioned, that we are the only ones in the market whose own sister concern is doing market making in their ETF. In all bad days when markets were correcting significantly, we were the only ones who continue to provide ETF, both liquidity on both buy side and sell side at correct levels, and we have done it continuously. So I'll say that uh, that this is uh, probably we are probably the best in terms of market making in ETFs. Yeah. So I've got couple of ideas on which once we have an update ready on EV fund, we'll probably share on those. So thank you everyone for sharing and for for so many questions, and thank you for joining this webinar. I'll just take a very quick snap of the email IDs which have been shared. Yeah, great. And thank you for joining. I hope do join us for other sessions also. Take care and good.